Good afternoon. This is Ash Heatwole, Director of Wealth Management at Graves Light Lenhart Wealth. In this update, we will speak to current economic trends, recent themes for the past quarter, as well as our recommendations for current portfolio positioning for our clients. For those who wish to study this presentation in more detail, we have provided a link in the message sent to clients to access and download the slides for further analysis. As always, please let us know if you have any questions or if we can be of assistance. Over the last 3 months, we witnessed wild vacillations across markets as sentiment swung from despair to euphoria as tariff-related developments have continued to evolve. In observing these swings, we are reminded of the time-tested importance of allocating in a way which enables our clients to remain invested without needing to time the market. During the early part of the quarter, we witnessed some of the largest short-term declines since the early part of the pandemic, swiftly followed by some of the sharpest multi-day snapbacks in recent history. The unpredictable pace and timing in both the price decline and rapid recovery underscores our view that the best way to be allocated in an ever uncertain world is to be diversified while holding securities which can help offset these uncertainties as they inevitably arise. To reiterate the message of our update sent in April, this is why we design portfolios based on the principles that we can control, such as ensuring your portfolio is well-rounded while carrying an appropriate mix of attractively valued investments to obtain your long-term financial goals. While first quarter GDP was negative and recently revised downward to a 0.5% contraction, the economy in the second quarter exhibited signs of resilience. As of July 9th, the Atlanta Fed GDP Now estimate of real GDP growth for the second quarter was a healthy 2.6%. Tariffs, which function similarly to sales tax, continue to dominate the economic story and carry the risk of further economic disruption. However, delays in the implementation of those tariffs coupled with preemptive imports have mitigated the potential economic fallout to date. One complicating factor in the current environment is the potential of tariffs to spur inflation. Inflation continues to run persistently above the 2% self-imposed benchmark set by the Federal Reserve. The Personal Consumption Expenditures Price Index, or PCE, was 2.3% in May. This, coupled with inflation-related tariff concerns and a relatively low U.S. unemployment rate of 4.1%, has combined to induce the Federal Reserve to keep the federal funds rate in the range of 4.25 to 4.5%. Political friction around the maintenance of this level has raised important questions about the independence of the Fed. As the term for the Federal Reserve Chair expires next spring, this is likely to be a key issue in the coming months and perhaps years. Federal government fiscal deficits in the United States continue to be the norm. Recent law changes have made permanent the reduction in marginal tax rates that were passed in President Trump's first term. The economic implications of institutionalizing federal deficits such that they exist, even during times of economic prosperity, are complicated. Just as a lower federal funds rate provides a stimulus to the economy, so too does government deficit spending. The counterpoint to this increased stimulus is increased federal debt. U.S. federal debt currently stands at 121% of GDP, while the annual deficits add to this at a rate of about 6.3% of GDP. Economists are uncertain what level of debt is tolerable for an advanced open economy such as the United States before negative implications of the debt begin to manifest themselves. The U.S. government finds itself in the company of countries such as Italy and France in terms of its overall debt level. However, Japan is the developed country with the greatest debt levels, far outpacing other developed countries. By contrast, debt at the household level in the United States is well under control. After 15 years of unwinding from the financial crisis, U.S. household leverage is at low levels not seen since the early 1970s. This should imply a degree of resilience for American households in the event of economic stress. Since the beginning of the year, the U.S. dollar index, which calculates the strength of the U.S. dollar against a basket of international currencies, fell approximately 11% through June 30th. This has the implication of bolstering U.S. corporate sales abroad, but places upward price pressure on foreign goods and services in the United States. However, the dollar index had been bid up after the U.S. presidential election in November through the end of 2024. While the dollar index is at its lowest level since early 2022, its downward movements are not yet at concerning levels. While the direction of travel of the value of the US dollar is noteworthy and important to monitor, when viewed in a recent historical context, the level of the US dollar is not such that alarm is warranted at present. As discussed in previous communications, many asset class returns have experienced alternating underperformance to outperformance over each of the past few quarters. For example, the S&P 500 Growth Index achieved a stunning 18.9% increase over the recently concluded June quarter, shown in the table on the left, following an 8.5% decline during the previous quarter, shown in the middle table. In comparison, the S&P 500 Value Index generated a solid but relatively anemic 3% return during the recent quarter, following a slightly positive return during the first quarter of 2025, which significantly outperformed its growth-oriented cousin. A common theme during the June quarter was the strong relative outperformance of the riskier segments of many asset classes in the face of uncertain economic policy, which may contribute to heightened future risk to such holdings if circumstances prove more challenging than expected by these more aggressive dip buyers. Of note, international stocks broke the alternative quarter performance theme with strong performance during both Q1 2025 and Q2 2025, leading to an outsized 19.9% total return over the first half of 2025. The S&P 500's solid 6.2% return during the first half of 2025 included unusually volatile price swings in both directions. Furthermore, the entire cycle occurred over an abnormally short time period. The chart on the left shows the typical market experience during market corrections of more than 10%, with the median experience represented by the black line and the typical range denoted by the gray area. The S&P 500's current cycle, as shown by the blue line, demonstrates the abnormally deep decline quickly morphed into one of the strongest recoveries, with the entire cycle occurring over an unusually short time period. Furthermore, the charts on the right demonstrate that unprofitable stocks have been a major driver of the market's rebound. We find this dynamic to be a dangerous cocktail, especially given the still uncertain environment, and continue to favor reasonably valued, higher quality holdings. Small cap stocks experienced a strong rebound during the June quarter, but still lag the performance of S&P 500. We continue to believe that small cap stocks are priced for superior longer-term performance due to more reasonable valuation and future estimated EPS growth relative to their large cap brethren. Importantly, history has shown that higher quality attributes such as balance sheet strength and profitability have been a major driver of the long-term outperformance of small caps. Our small cap exposure has targeted the higher quality S&P 600 index instead of the more commonly cited Russell 2000 index, especially as roughly 45% of the Russell's constituents do not make money. Nonetheless, the aforementioned outperformance of unprofitable stocks is present in the small cap universe as well. The chart to the right shows the performance of the S&P 600 versus the Russell 2000 over the past 12 months, ending June 30th, with both experiencing a similar decline as the threat of high tariffs became a real possibility. While the worst fears of that time have moderated, the tariff issue is still unsettled. Yet the lower quality Russell 2000 enjoyed a meaningfully larger rebound, which leaves us scratching our heads, but we remain committed to higher quality small cap exposure as an important part of client portfolios. The S&P 500 has enjoyed strong performance for some time, both absolutely and relative to other major global equity market segments, which has been popularized as American exceptionalism. U.S. companies have produced strong earnings growth, especially as profit margins have increased to all-time highs. However, the S&P 500 earnings growth has been matched by certain countries. For example, the chart on the left shows the contribution of earnings growth, shown in dark blue. Focusing on Japan versus the U.S. shows that the earnings growth was in line with the main driver being the sizable expansion of the price-to-earnings multiple, shown in gray, for the S&P 500. In contrast, Japanese stocks did not experience any change in valuation multiples and felt the drag of currency movements versus the US dollar. This combination of currency drag for U.S.-based investors and stagnant valuation led to Japanese stocks experiencing only half of the S&P 500's 14.9% annualized return over the past 15 years. This dynamic was even more apparent during 2024, as shown in the middle chart. These dynamics have changed so far in 2025, which we believe could last for some time. The significant outperformance of international stocks so far this year raises the question of whether investors underallocated to international stocks have missed the opportunity. The chart on the left vividly displays the sharp outperformance of U.S. stocks relative to the rest of the world, especially over the past 10 years, to levels well in excess of the experience of the previous 60 years. In our opinion, this disparity provides the opportunity for U.S.-based investors to experience a significant period of outperformance from their international equity holdings. Historically, a major driver of the relative performance between U.S.-based stocks versus international stocks for a domestic investor has been the relative value of the U.S. dollar. Essentially, a weaker dollar supports superior results from international holdings and provides diversification benefits against a depreciating dollar to U.S. investors. The chart on the right demonstrates this dynamic, and the U.S. dollar index, shown by the green line, rises as U.S. stocks outperform, shown by the blue area, while international stocks outperform, shown by the orange area, as the green U.S. dollar index line declines. In sum, the more attractive valuations of international stocks and an uncertain path for the U.S. dollar are likely catalysts for international stocks to embark upon a multi-year period of outperformance versus U.S. large-cap stocks. We also continue to see international stocks as relatively inexpensive when compared to large-cap U.S. stocks. The illustration on the left-hand side of the page reflects a yawning gap when comparing the value of the U.S. stock market as a percentage of the overall global stock universe relative to its underlying earnings output, as shown in the chart in the upper left. In essence, this implies a much higher valuation for U.S. stocks when compared to international securities, as shown at the bottom of the left-hand illustration. This is even after the most recent period of international outperformance. The picture on the right-hand side, showing relative valuations by sector, reveals that the discount for holding international securities is indiscriminate across sectors, underscoring our recommendation for portfolios to hold stocks domiciled outside of the U.S. This slide provides a look at the stated yields as of the most recent June-end quarter across an array of key fixed income or bond markets. The stated yield reflects both coupon and potential price return across these markets and provides an approximation for the potential longer-term returns so long as the underlying risks of the relevant segment remain under control. The diamonds indicate quarter-end values relative to their 15-year range and overall provide indication that ample opportunities remain across fixed income markets from both a return perspective as well as for diversification benefits. The picture on the right shows the shape of the U.S. Treasury yield curve with the interest rates matched with their appropriate maturity date from 1 month through 30 years. The blue line represents the curve as of the end of 2024, and the red line shows the curve at the end of the most recent quarter. Clearly, the shape of the curve has changed as the bond market regularly adapts to potential changes, in this case rate cuts, for Federal Reserve policy. Moreover, the longer end of the interest rate curve tends to be more impacted by underlying economic developments, Treasury bond supply dynamics, as well as future inflation expectations. As this interest rate curve shifts in shape, so may the opportunity set within fixed income markets, and particularly U.S. Treasuries. This may warrant future adjustments to clients' bond positioning in the event that the yield curve continues to steepen, as our recommended bond positioning in recent quarters has targeted more intermediate dated bond securities, commonly referred to as the belly or middle section of the rate curve. Thank you for your time and interest. Shorter-term market movements are always unpredictable, which highlights the importance of proactive planning and developing the confidence to make sure the elements of such plans are consistently implemented. We hope you found this information useful and that you are more comfortable with the positioning of your financial assets. As always, please let us know if you wish to discuss these or any other issues. We're here to help.